What do you do when markets break and everything you thought was safe falls with them?
I would choose tokenized T-bills for this one just because there are all kinds of shocks that could come in. Tokenized T-bills is basically cash that gives you a little bit of carry. It could work in almost all scenarios.
If I could put a little bit of a spin on it, I would take the gold, but I would hold it probably as a partially hedged position using futures to generate a T-bill-like yield with the contango, but also so that I have the ability to exploit gold status as tier 1 capital.
Welcome, my name is Jacob and this is another episode of Being Crypto Market Intelligence Experts Council. And today I have amazing gentlemen, amazing guests, Iggy Ioppe and Gordon Grant. Before I properly introduce you gentlemen, let me ask you first direct question. Let's imagine that you can hold only one thing during the next macro shock. It can be either gold, cash, treasuries, Bitcoin, or tokenized T-bills. What is it? And in one sentence, why? I will ask Iggy first. What would you hold? One thing.
I would choose tokenized T-bills for this one just because there are all kinds of shocks that could come in. If you don't know exactly what the nature of the shock is going to be, is it inflationary, deflationary, right? Is it going to lead to more jobs or fewer jobs? Then sort of tokenized T-bills is basically cash that gives you a little bit of carry, so it would work in almost all scenarios.
Perfect. Thank you for this straight answer. Gordon, what is your selection?
If I could put a little bit of a spin on it, I would take the gold, but I would hold it probably as a partially hedged position using futures to generate a T-bill-like yield with the contango, but also so that I have the ability to exploit gold status as tier 1 capital, so that in a macro shock, when liquidity is at a premium, I have an ability to access it from gold status, and I could potentially also utilize the deep liquid derivatives market for gold to be able to, create some alpha through that position. Some of those same things are true for Bitcoin, but not quite as true as they are for gold.
Well, thank you for this one.
I think Gordon just described.
Yeah.
Sorry to interrupt, but Gordon just described our flagship product. So I promise I did not.
No, this was not prescripted at all.
Him for this. Yeah.
Well, for me, that was the most sophisticated answer I could get. Amazing. Thank you very much for that. And we went directly to our main topic, which is how to hedge against uncertainty in this unpredictable market. And let me properly introduce my guest today. I'm accompanied by Iggy Ioppe, is CIO at Theo, former head of 1 billion plus USDT long-short property trading group at Credit Suisse, co-founder of SureView Capital and Location Labs, Harvard MBA, now building institutional grade on-chain strategies. Iggy, how are you doing today?
Great to meet you. Looking forward.
Thank you very much. And my second guest is Gordon Grant, portfolio manager and head of derivatives at Bitwise, built Genesis's regulated derivatives desk into crypto's top sell-side dealer. 2 decades trading volatility across FX, rates, commodities, and crypto in digital assets since 2013. How are you doing, Gordon?
Since before they even existed.
Wow, since before many people knew about them, and certainly before digital asset derivatives existed. But I'm doing great. It's fantastic to be here with another innovator and a financial luminary in the space, and very excited to be having this conversation now when Bitcoin really is kind of behaving like a macro asset and the macro turbulence is picking up, shall we say. We're going into macro hurricane season.
Well, that's going to be our topic actually, because the first section about the regime and how to manage the Trump era chaos is the first broad topic I would like to start with. And let me open with like a perspective that we will try to find an answer to the question of what kind of volatility are we actually living in and why do the textbook hedges misfire nowadays. So there are tariff whiplash, election cycle policy reversals, treasury squeezes. Is Trump era volatility just louder normal volatility or a genuinely different regime that breaks the stock-bound playbook institutions have relied on 40 years? Gordon, would you like to start answering that question? Is Trump era volatility very different from what we saw before?
I think so, but I'm going to characterize what we mean by difference. Difference in the sense of if you were to take a distributional mapping or some sort of approximation of the way in which returns of different assets vary and independently as well as in a covariant sense, you can see a differentiated nature to those behaviors. And part of it is because there is now sort of a jump process that's been introduced to large cap liquid asset classes around policy-driven shocks, right? What have you? Tariffs, for instance, election cycle, which created its own degree of volatility. And then more recent things like geopolitical disturbances in the Persian Gulf and the on-off switching around that, as well as other policy frameworks, including things like Greenland, for instance, which no one imagined would be a source of market consternation, but has become one. And if you were to take a basic, I say basic, but a relatively robust econometric test for distributional similitude or difference, like a Kolmogorov-Smirnov test, you would find in several key asset classes that there are inherent statistical or econometric differences between the behavior of assets pre-Trump era and post-President Trump era. Now, that doesn't mean that they will have to persist because this is exogenous, right? These are policy decisions that are driven by a single individual and his team of advisors that are making them. And there's no reason to necessarily project that this heterodoxy that we've seen so far would perforce continue into a different administration or even to a different year. But they have introduced difference, and that difference has certainly led to kind of the shifting sands, the shifting cross currents in the macrosphere that has led to traditional stock bond portfolios not doing as well, right? The years of risk parity in a Ray Dalio sense has clearly begun to shift, but other things have begun to shift to some of the long-held relationships. And even within the last 12 months, what precious metals have done versus large cap liquid equities, growth versus value, small cap, large cap, or even crypto versus gold, crypto versus commodities, and then crypto within itself, for sure.
Yes, thank you. Iggy, what's your view on that? Do you think this new regime is qualitatively different?
I think there's always been kind of reasons for volatility. There's more unpredictable. All right, so there's kind of like, I think that was Donald Rumsfeld or something, that he had the known unknowns and the unknown unknowns, right? and usually it's the known unknowns you can sort of either hedge, right, or you can just sell your position or reduce it, or you can like revise your case and basically not be bullish anymore and just forget about that asset class. But I think there's more unknown unknowns right now. But in general, like it seems like also like these unknown unknowns, they seem to be very short in duration, right? So it's kind of the taco trade or that Trump always chickens out. So sometimes they reverse literally within a day. Whereas like the true shocks that are not imposed just by the whims of one man, the true shock, in the past, when something went wrong, it sort of stayed wrong for quite a while. There wasn't an easy fix to it. So just like overall, it's certainly, if you look at the markets, I mean, most of the equity valuations, credit spreads, volatility is quite low. Credit spreads are quite narrow. Valuations are quite high. So certainly the market is no longer discounting like a lot of risk. So I think like it's different kind of regime, but it's definitely not a sort of a kind of a environment of extremely high risk. I think there's like more of this like short-term volatility spikes, but it's overall it's not a I'm not super fearful overall. I mean, I have to go asset class by asset class, right? It doesn't mean by everything, but it's constructive, I think.
Yes, this roller coaster of volatility is definitely speeding up these days. However, doesn't have that profound meaning anymore. Let us move to digital asset class, Bitcoin namely. And my next question is, we'll start with Gordon, and then Iggy, if you could continue, please. Every time we get real scare, Bitcoin falls harder than stocks. That was already proven, like in the past. For example, COVID, the tariff shock, you name it. At what point does the digital gold story have to admit defeat? And what would have to change for it to actually behave like a hedge when it matters? Gordon, what do you think about it? How can Bitcoin be seen here?
It's a ongoing debate. But I think first precepts, what do we mean by the expression digital gold? So in the past, investors often would have said gold is a hedge against macro uncertainty because it tends to go up, let's say, when we get into a tail of the distribution of some sort, right? For instance, May 2010 flash crash, right? You have stocks like Procter & Gamble go down 90%. Gold was up in that market. back around the same time, Iran elected a hardline president, Mahmoud Ahmadinejad, and he talked about introducing newer nuclear capabilities for the Islamic Republic. Market didn't know how to deal with it. Gold goes up. You had Dubai Pert's world default on Thanksgiving Day of 2009. Gold goes up. The rest of the assets are getting tanked. So that's kind of gold behaving as a safe haven. But the reality is the number of times that gold goes up when everything else is getting thwacked is actually not that often. It's that gold shows more resilience, and gold is something that people have been willing to get into after they sell everything. So like, look at the global financial crisis. Gold actually went down during the GFC. Gold had a brief rally in the spring of 2009 when quantitative easing was introduced, but it didn't really begin its multi-year secular uptrend until we got into the 2010-11 era. So gold is not necessarily safe haven or macro hedge by dint only of its price distribution. It's how it begins to decouple from other assets, right? And gold functions as a macro hedge not because it's guaranteed to go up when volatility in general rises, but it's that, at least from my perspective, it starts to become less correlated to other large cap liquid assets when times get tough. It is the conditional covariance of gold's returns versus the returns of other marquee asset classes goes down as overall systemic volatility increases. But that's not a guarantee of outperformance. And so I would argue that Bitcoin now may be going through that same kind of conditional decoupling, right? And we've yet to pressure test that against a rise, a systemic rise in volatility. But Bitcoin day to day is becoming less correlated now than it's been before to other large cap liquid assets. For instance, tech stocks have had some big sell-offs recently, or some major swoons. Let's not call them a sell-off. The percentage year-to-date returns are still incredible from Micron, AMD, Marvell, Palo Alto Networks, and others. But Micron sold off 30%. Bitcoin didn't do anything. MicroStrategy itself sold off a huge amount, and Bitcoin is actually higher than it was when MicroStrategy was considerably higher. So I'm not yet ready to give up on the digital gold-like correlative decoupling characteristics of Bitcoin yet, because I'm seeing it do some of the things that we've seen gold do in other cycles, that we've seen other precious metals do in other cycles. I'm also paying close attention to, at a fundamental level, and I'm not a fundamental trader, should be noted. I spend my time looking at derivatives alpha, but I'm paying attention to who's buying Bitcoin or who appears to be holding Bitcoin. And there's an increasing set of cohorts amidst the BRICS countries that seem like they're holding some Bitcoin, right? Iran, Russia, Venezuela, maybe the UAE, maybe Saudi Arabia, we don't know, maybe Qatar, maybe some countries in the Far East, maybe China, Kazakhstan. And if those countries are starting to keep a position in Bitcoin and accept Bitcoin as a mechanism for commerce between themselves when times are tough, sanctions are being imposed, or there are other macro workarounds that need to be considered, that also would give me confidence maybe that the gold story is not dead yet for Bitcoin. If you remember, there was a big kind of scandal that broke out some years ago about an Iranian Turkish gold trader named Reza Zarrab, who was arrested on a trip to Disneyland and subsequently prosecuted by the feds. And what they found out from Reza Zarrab is that Iran, no surprise, was using lots of gold to move its money all around the world when it was under the strictest sanctions that were imposed by, I think, both the Bush and the Obama presidencies. And so if Bitcoin is being used in that way, that's not necessarily great for the reputation of Bitcoins, because people don't want to think about this. That's how gold has been used, right? It's been the thing that people go back to when nothing else works. Even if the price volatility is high, they know they can get their hands on it, they can move it, it's liquid, and it's hedgeable. And I think this is the most important thing. As long as derivative markets are functioning for Bitcoin in a way where you don't care where the price goes, you can always get liquidity on a hedge and turn it into synthetic dollars, I'm also not ready to give up on the digital gold narrative for Bitcoin.
Thank you very much. Very interesting point. Narrative that has always been there, but looking from different perspective. Iggy, what's your view on the digital gold narrative for Bitcoin nowadays?
Yeah. So I think Bitcoin is still a form of digital gold. It's sort of another type of digital gold. And by the way, gold, of course, is also digital now, thanks to, first of all, you always had gold ETFs, not always, but for quite a long time. But now you also have gold on chain, which allows it to do a lot more with it, like structured product, which we'll probably touch upon. So now you have these two types of gold that behave differently. They're both digital. They're both accessible anywhere in the world, right? Even in places that are either kind of sanctioned and then kind of bad guys, or even at places that just don't have necessarily the infrastructure to access modern financial products. So that's all good. I think Empirically, in recent times, Bitcoin has, and I would have answered differently, like maybe like a year ago. But in recent times, the Bitcoin has not acted as a good hedge. Just right. So I think maybe if you structure, if you're truly a derivatives expert like Gordon, you could structure something that would always work. But if you're, so me, I'm actually buy side, right, guy. So I look at it quite simply, right? Bitcoin is down almost 50%, so it definitely hasn't worked. Now it's down, of course, from like extremely high level. I think as far as for investment purposes, Bitcoin is very much still digital gold. But different characteristic, like for example, the clientele effect, right? So boomers love their gold, right? My friends' parents, they have some gold in their portfolio. Very few young people have gold, but quite a lot of them have Bitcoin. Boomers have Bitcoin too. So, but definitely is more. I think if you're gonna have somebody who is a Gen X, millennial, Gen Z, who wants to not necessarily hedge, but let's say risk off a bit of their portfolio, that they're more likely to buy Bitcoin. And then over time, Bitcoin will still work, right? So let's say if you have, and also have to look at what are you hedging against? Is it inflationary? Is it deflationary? Is it growth shock, job shock, or just strictly geopolitical? So if you have sort of more inflationary shocks over time, in the medium to long term, Bitcoin will actually work. But it doesn't work super well in the immediate aftermath of a shock, because right now, so Bitcoin in particular, right? So it does have this like sound money thing, but it also it's a sandwich. Bitcoin also has it's kind of a Mach 7, like maybe like the number 8 of the Mach 7. So it has also it's kind of a tech, and then the third part of the sandwich is just pure speculative element. So the tech and the speculative element, they're gonna, they're actually risk assets, and then underneath there's this like solid foundation of a kind of a digital gold or a risk off asset. So that foundation prevails over long-term disruptions, but in the near term, the speculative aspect prevails. And by the way, gold has become a sandwich too, right? So gold historically has been a kind of the stodgy asset for central banks, for boomers to hold, for like gold bugs to keep under the mattress in the forest with a shotgun. Kind of like maybe Gordon right now. Looks like he's in the forest there with his gold.
There's no gold in this cottage.
Okay, that's what he says. We'll take your word for it.
Maybe digital. Well, thank you guys very much. Let's move on to the second section I prepared. This is going to be a little trip to hypothetical parallel reality, the Sunday night test. What would you do if, right? So let's imagine it's a Sunday night, something big just broke. Features are already down and you're running money. Walk me through what you actually do. What pays out first? What do you sell? And which hedge that people think they own turns out to be useless when they need it most? Iggy, would you like to start diving into this hypothetical reality of Sunday night crash?
Yeah, I think if you're if you're long Bitcoin, for example, thinking that it'll protect you against a Sunday night crash, obviously Bitcoin trades on Sundays. So as from a trading perspective, it would give it, it would have given you cover, but as we discussed before, it's not going to work as a hedge that will like protect your portfolio, because if there is a crash, especially if it's like a risk off type event, then Bitcoin will go down. I think on-chain gold will also go down initially, because gold has that also become the sandwich where you have the fundamentally anti-inflationary and kind of an asset protection, rainy day, all this stuff, and then you have a very strong speculative element in gold that really is a very recent thing. That's only in the even so central banks started buying in 21, 22. Gold started rallying in 2023. But the speculative element, which is like mostly kind of a Western portfolio investor, CTAs and retail, that's really maybe 2 years ago. So that type of group in a risk-off event, they will sell everything, and correlations go to 1. So gold will sell off too. So I think that will probably fail. Obviously, the on-chain treasuries will work because it's cash, right? So if you define your returns in dollar terms, right, then that will not decline because it literally is dollars. I think if you have the correct hedge, I'll leave it for Warren. But if you structure something before the crash, right? So you don't hedge during the crash. So I'm assuming the question is you had something before, and now we're evaluating whether it worked or not. So if you're already in the crash, then you don't hedge. At that point, you look for buying opportunity. But if you I mean, like again, I'm not a vol expert, but Bitcoin seems pretty washed out. Even though like the implied vol is very low by historical standards, in absolute terms it's still pretty high, and the put skew is quite high. So I don't, I think it would be probably expensive. I always think in terms of, hedging should be like, maybe it's a bit conservative, but no more than 50 to 100 basis points cost or drag to my portfolio. So I don't know if you can structure something with Bitcoin that would fulfill that, and gold is a little bit less washed out. So I think gold could do okay, but in the if you're just looking to protect it until markets reopen, that gold is unlikely to work too. So the only sure thing is to be in on-chain treasuries, and then watch for buying opportunities depending on how far things sell off.
Thank you very much, Iggy. Gordon, what is your playbook during this Sunday night crash? What would you do?
Well, I'm going to go back to my old days in macro land, where I spent 10 years as a PM at a multi-strategy fund. I think the quality of a hedge, statistical quality of a hedge, which of course is an inferential, forward-looking perspective about how likely it is to perform under certain conditions. It depends on positioning, as he has been saying, how much is something washed out or how stretched is positioning in it. You're not going to be getting into high beta tech stock shorts on a Sunday night, even with Kraken X stocks and Coinbase and others out there offering it. There's just not enough liquidity to get fills, although it will be more interesting as it does. But I actually think cross yen is starting to get interesting again as a potential tactical hedge. And again, not a solicitation to take action or withhold from taking action with regard to any security, commodity, or foreign currency. And I'm not making any recommendations about trading Forex and my day job, certainly. But from a macro perspective, cross yen, meaning G10 currency pairs typically on the left-hand side and the Japanese yen on the right-hand side, is starting to get interesting because the narrative around the yen is bearish. Positioning short yen has been building. It has been setting up with some BOJ interventions, and there could be potential for a washout in yen shorts, especially if it's in liquidity on, let's say, a Sunday night. So if you have to take action in the midst of it, I like that. I also like it because it fulfills Iggy's condition of implied volatility on G10 currency pairs, even cross yen, being pretty low by most standards, right? So Bitcoin implied volatility now is around 35. Depending on the cross yen pair, you might be able to get implied volatility in the single digits, which is a lot different. So you're risking far less if you want to go and let's just buy some yen call, euro puts, or sterling puts, or Aussie puts. Aussie yen used to be kind of the widowmaker trade that performed spectacularly as a macro hedge in Lehman Brothers time. In fact, I remember I was pre-positioned, to Iggy's point, but I remember it was right around Labor Day weekend of 2008, and I had a fairly significant book that was full of yen calls and puts on, sort of higher flying G10 commodity currencies like the New Zealand dollar, the Australian dollar, the Canadian dollar. And those perform spectacularly well, even on a delta hedged basis, because implied volatility performs so well. Now, do I think that we would necessarily see a 2008 style explosion in implied volatility in cross yen simply because we have a Sunday night sell-off? Not necessarily, but look at where the yen is. I mean, the yen is very, very stretched, on a purchasing power parity basis from a short perspective. And the BOJ said they want to intervene. So that's interesting to me. I think from the kind of hedges you might want to put on that are more closely correlated to something like Bitcoin prior to this event. And again, this is not a solicitation to take action or withhold from taking action in terms of any security, commodity, digital, or otherwise. But some of the close correlated assets that trade in equity land on Bitcoin can be interesting from a vol perspective. So if you look at mining companies, mining stocks, Bitcoin mining stocks that hold a lot of Bitcoin, and you look at what their vol is relative to BTC, there can be some phenomenal opportunities there because they can expand to the top side. Let's say when people get excited about the prospects of such a company becoming a data center operator and they forget about the Bitcoin that it holds and they go, hey, they did a deal with XYZ and they're going to be doing data centers in state ABC. But when they hold couple billion of Bitcoin on their balance sheet, that can start to matter and those stocks can snap back. And so, when the opportunities present themselves, if you can trade put trees, put flies, put 1x2s, put seagulls, and hold those as a volatility focused position over time, they can have quite positive decay characteristics and they can also have quite positive delta characteristics in that left-hand tail event. Again, subject to the name, the individual name, subject to the positioning, subject to earnings, subject to the data center deals that they're doing at any given time. But I think those kind of crypto correlative names can be interesting as a hedge that you would like to have had before Sunday night rolls around, but can do quite well when you think about the bang for your buck that you get when you're talking about hedging that type of stuff.
Okay, thank you very much for these exhaustive answers, both of you. Thank you very much. Let's move on to our last section. But before we go there, it's about hedge on trial. I want to tell you a few statistics we did on our LinkedIn and X, both of them. Actually, we asked our audience about like the same question we are discussing. If you could hold one of these things next to next macro shock, what would you choose? And there was gold to choose, cash, Bitcoin, and treasuries. And 54% of our audience chose gold. Then only 13 cash, 29% chose Bitcoin, and only 4% treasuries. Let me ask you the next question about your personal war stories, your personal experience. All these potential hedge safe havens, everyone pitches their favorite hedge, but most of these have failed someone in real crisis. Could you please tell me about a time when hedge you believed in didn't work? What did that teach you about where the real risk sits? Please go ahead.
Well, I can grab the jump ball there. It's certainly there are a lot of hedges throughout history that I could look at. I think one of these, going back to my macro days, that is interesting, is that as a fund, at New World Investments, we had a number of positions right across the entire firm, and we had some systemic hedges, some in emerging market currencies, some in credit product, some in commodity land. And I remember particularly one of the worst performing hedges that we had for a long time was a CDX iTrax, tranche. And the thought process was that it was a very tight spread. It was like for 20 or 30 basis points, right? You could hedge a huge amount of risk, and you go, I think it was European, like high grade, something like this. And, we said, look, just put it in the book, right? 15, 20 basis points. You can hedge, billions of risk for, hundreds of thousands of dollars monthly, millions of dollars of years, millions of dollars, annually, and have it. And every time we would get a big shock, and it could be like the European sovereign debt crisis. And I remember that was the one that blew everybody's mind. We were going, Greece is blowing up. Belgium is blowing up. The pigs are blowing up, meaning Portugal, Ireland, Greece, Spain, Italy. And this iTrax tranche, it didn't move. And everyone was going, by gosh, what's happening here? And I think the lesson that we all learned after that was everyone saw the same thing. We saw that it was highly convex, but everyone was in the trade. So anytime it widened a little bit, there were another dozen hedge funds out there that had billions of exposure in this thing, and they were waiting just to sell their protection on that iTrax tranche and get out of it. Another example of a hedge that appeared to be convex, but it never worked, in any scenario that I've gone through, are shorts against GCC currencies. So that's one that people have been excited about for various points in time, so-called widowmaker trades, dollar calls, Saudi Riyal puts or Kuwaiti dinar puts or whatever it is. And you could extend it to other types of strong currency boards, whether it's the Hong Kong dollar or others. These things just don't tend to move. The vol is very cheap, but they don't tend to let go in spectacular fashion. Everyone's waiting for that to happen. And guess what? You've got the Saudi central bank on the other side going, listen, I've got $1 trillion of Aramco income that is not going to let this go. And that brings me probably to the most spectacular one in crypto years, that, at Genesis, we never wasted money on, but we had a number of clients that did, who shall remain nameless. But we had clients, multi-billion-dollar hedge funds coming in to buy puts on Tether. And there was always a story going around that Tether was going to be the next linchpin to blow up in crypto. Just had to happen. UST blew up. USDC even decoupled in March of 2023. People couldn't believe this. I remember I was on a call for a nameless 3-letter market making firm and the estate of a major crypto exchange, and they had lots of this stuff. And people go, USDC is at 89 cents. What should we do? And Tether was sitting there pretty rock solid. And some people were saying, short Tether, right? You can short Tether on this exchange or buy puts on Tether. And every time I hear that, it's not that I don't think that Tether has fragility. Every asset has fragility. But Tether has just shown that it actually might be anti-fragile statistically, regardless of what I think about it and the business of Tether. So that's probably the worst widowmaker trade, right? On that long list of the iTrax CDX tranche and the Saudi Riyal puts and GCC currency puts. But Tether, my gosh, I've seen more money wasted by smart people, far smarter and more successful than I by orders of magnitude. They still fell victim to that trade. So I'd have to put that up there. A hedge that never worked on yet. let's
Yeah,
say yet.
great job thinking of that. Actually, yeah, that's like probably the most. That's definitely the champion of hedges that didn't work. There are still people, by the way, the old school TradFi that are still fighting. We can I don't know if we can use the word in the podcast, but expressing doubts, clear uncertainty and doubt about the other. So that is still a thing, believe it or not, even though they're in the process of getting a full audit. But they're saying, oh, wait until the full audit comes out, then we'll finally know the truth about Tether. So yeah, I would.
There's a book out there, a Reddit thread out there, a gazillion things out there about it. But for sure, and I mean, Iggy, you can relate when you're in the midst of a crisis and you think you've got that apex hedge and it doesn't work. Oh God, it burns. It really burns.
Yeah, exactly. Iggy, do you have any stories similar to this one? Please, could you share with us, please?
There's a few I was just thinking about while guys were talking. I mean, actually, interestingly enough, this is maybe not ahead, but keeping money in Silicon Valley Bank. So before I went into the hedge fund world, I built a software company. We had our money in Silicon Valley Bank, SVB, many other startups, VCs. It was like nobody could ever imagine, right? Some of the smartest people, like trillionaires, right? They all use SVB.
And how about First Republic Bank? Same thing. I was a First Republic Bank client. I thought never,
Yeah. So certainly nobody would think that keeping money in the bank with you think that that's a good hedge for sure. So that was probably a big disappointment in along the lines with the USDC there. If you go back to since we keep reminiscing about the GFC, I remember I was running prop trading at Credit Suisse in New York and in Hong Kong, and I inherited a book there that had a lot of event-driven positions, a lot of small caps that were trading in Hong Kong, and they were trying to hedge it with HSI futures. And when the crisis, and then, so Asia started falling apart kind of before Lehman in the summer of '08. A lot of these, basically the bids disappeared. So some of these like small cap names, there would be like no trades for several days. Whereas HSI is like a super large cap, very narrow index. And in fact, what happened is they were losing money on both sides. So they were shorting HSI. And it was doing quite well because there was a rotation into the bigger, safer names initially before everything else went down.
This is it.
The small caps were already disappearing.
This is like the iTraxx one, but I'm going to give my last one actually, and I didn't have any horse in this race, but I remember it again. GFC reminiscence. Who remembers what happened to Volkswagen stock during the GFC?
Wasn't it something with Porsche?
Yes, and it had an absolutely parabolic short squeeze. You've never, I mean, there was no short squeeze in a name that large, probably ever. And certainly not until like GameStop and these other kind of meme stocks that squeezed and destroyed, any number of hedge fund portfolio managers during the post-COVID era. But I think Volkswagen stock went from like a couple $100 to like $1,000, bucks or euros a share on the DAX in that time. And I just remember watching it in the midst of trading a lot of other stuff, but watching Volkswagen go. And people were short that name, and they were shorted because it was a macro hedge, European economic collapse, industrial demand going down, and they were also shorted, I think, on a merger arb. I mean, that was probably the worst example of a hedge going wrong in every possible sense. But check a chart for anybody that cares about macro hedge history gone wrong. It's unbelievable, and I do always remember that one.
The other thing, okay, so this is more of a longer thing that I thought of is actually so as we discussed earlier, gold had its moment after GFC all the way through like maybe 2011, where it was reacting to like the early QE, like the money, this whole money printer narrative. But then from 2011 until 2023, for 12 years, gold basically did nothing.
Yes.
Even though Fed continued to expand the balance sheet in an epic manner. Trillions and trillions were added, massive money printing, debasement, all that stuff, and gold completely didn't work. So a lot of the people were left frustrated, I guess, by that.
Brutal. That's a great one to remember, Iggy. It's so true. Gold hit $1,900 an ounce ish. I think it was maybe 2011 or 14. I forget, around the European sovereign debt crisis, as silver was coming off the boil from 50, and it didn't get back to that level 2000 for like 10 years, which is utterly insane. Difficult to contemplate. Those are dark days for the gold bugs. Peter Schiff and others who, of course, have been proven spectacularly correct.
Yeah, there was all the laughing stock. And in fact, I stopped following gold. I definitely was following gold, back in the day when people even denominated their hedge funds sometimes in gold. and then it was sort of completely forgotten.
Yes,
So
gentlemen.
now, and actually, what finally made the gold work was this, it was kind of a, extremely, so basically, it's the sanctions on the increase in sanctions, right? So a lot of
on Russia especially. That was it.
right, exactly. So, and then the other countries that like didn't invade anyone, didn't start wars. They looked at it and said, well, just in case, right? What if we do something? And it's kind of like maybe like not super moral, but like, well, just in case if we do something, let's start. Let's start buying gold for our central banks just in case.
Let's hedge our own morality. I still remember the Monetary Authority of Singapore. I think it was the largest ever gold buy in the shortest amount of time. It might have been Q3 or Q4 of 2022, when gold was around 1,800. And they took down an insane amount of gold. It topped the Indian government gold purchase from the IMF in the 2007-8 period. Have to check the stats, but amazing. Yeah, great things to think about, right? What makes a hedge work and what makes a hedge not work.
Absolutely. Thank you for all of these stories, and you talking about them with the smile on your face shows that you truly learned your lessons, and that's amazing to hear that we can have some good conclusions. Speaking of which, we need to slowly conclude our little panel. Great conversation. I have last question for you. This is a very, very general question, and I'm really curious about your answers. Is it now a terrible time to put money in the market, or the best time? What would you tell to your own family this week? Be honest.
Well, I guess I'll go quick because I just had this conversation with an extended family of mine that's down to see me from our neighbor to the north. And, my advice was to say that we're entering a phase of more unknown unknowns, as Iggy has said. And I love Rumsfeld's quote. I actually think of quantitatively as the unknown unknown as the fourth moment of the distribution, right? So it's basically the ketotic metric, right? Because that's it, right? Is if you don't have stability at the fourth moment of a distribution, it basically becomes approximately something completely untenable, like a Cauchy distribution, where it has undefined variance. You don't know what it is. And there are many things we don't know today about rogue AI agents and data center economics and space and wars and the nature of money. And therefore, it makes it a tremendously exciting time to be putting capital to work. And it also means, as a very wise friend of mine who's a senior leader at a large exchange, crypto exchange you may have heard of, he said, look, you have to start to actually force yourself and tell other people to tear up some economic textbooks. And therefore, I think it's a great time to put money to work intelligently, because if you apply your own proprietary analytical models, you can find real alpha, and you can find it in ways that are not obvious. But the cost of crowding into trades now, where there's excessive indexation, as Paul Tudor Jones has said, makes it perhaps more dangerous than ever, because you can look at statistics such as the amount of US wealth that is tied to the performance of the stock market is basically higher than it's ever been. No surprise, stock market's done tremendously well. But people are relying more on equity factor beta proxies to make their pensions fully funded, to actually use as a personal savings account rather than a bank account. And that optimism around economic outcomes, excessive optimism, particularly in some sectors, may create vulnerabilities that didn't exist 5 or even 10 years ago, especially when you include certain metrics. Not to say every metric is always relevant every cycle, but something like the cyclically adjusted price earnings ratio that bubble experts like Nassim Taleb and Robert Shiller and Paul Tudor Jones themselves have taken a look at. So I think it's both. And I do think that means that on a going forward basis, there's a risk that ketotic premium measured by the fatness of the tails of the distribution should go up. But it can also mean that, to Iggy's point, we can be more confident about the center of the distribution, because we said a little bit of noise matters less and less, right? It tends to mean revert quickly from a statistical sense. And the integral of that small amount of variance doesn't add up necessarily to a well-defined time series of big blow-up events, right? It used to be 87 stock market crash, 97, 98 Asia crisis, followed by the dot-com blow-up a couple of years later. 2007, 2008, we had, of course, the global financial crisis. 2013, 14, we had the European debt crisis. February of 2018, we had the Volmageddon event where the VIX went to 50, 60 on an afternoon and blow up a number of portfolio managers and so on. We're not having that 10-year cycle now, but that may mean that the tails are getting fatter, even though we can't perceive it. But it could be both the right and the left tail. Doesn't have to be asymmetric.
Thank you, Gordon. Iggy, good or bad time to put cash in the market?
Yes, I think given like the tails are getting fatter. So I would kind of decouple into. So there's a few like markets that I could mention here, and then the choice really is to not be invested, right? Sell or don't buy. The other one is just buy outright and hold because it's washed out. But the long term story is still good. Or buy and hedge, right? Occasionally something may be a little bit stretched, but you can get decent hedges in it because things are euphoric and you don't want to be out. So, for example, if you look at Max 7, I would just buy them outright. If you look at the performance, they've done nothing for many months, maybe a year, as earnings are continuing to grow massively. And people like worried about 700, people not used to Max 7 investing, becoming like a capital intensive companies. They say, oh my God, they're investing 700 billion into capex. In reality, you already have well over 100 billion of AI revenue, which is like pretty high margin revenue, actually, if you model it through. So you don't need 700 billion of revenue to justify 700 billion of capex, right? If you have 100 billion of revenue, and let's say you have a billion of capex, there's some sovereigns also that are building data centers, like messing around with foundation model. Let's say you have a trillion. Sorry, I meant a trillion. Let's say you have a trillion of capex, and you already have 100 billion of revenue. Let's say even you get only 50 billion of cash flow on that. So that's already a 5% return, but that is doubling every few months, right? So if you look at like the cash flow return that will be generated in that investment, it's actually massive. So meantime, like people are not doing the math. They think that $1 trillion of capex is totally nuts. It just because it's much higher than historical standard, but that's not the valid argument. The valid argument is I'm going to get a return. So I think, and then Max 7 have done nothing, and the valuation relative to growth rate, relative to how tech so is quite reasonable. Now, I'll quickly rip through a few others. The remaining, the 493, S&P 493, which is S&P 500 minus the Max 7, that has actually performed really strongly. The valuation is at very close to like kind of a all-time highs or definitely like close to that level. But yet, so I wouldn't. So this is the buy and hedge. Because they actually the hedges are cheap on those stuff. So you can think of it, you can get an equal weighted S&P 500 ETF will get you a similar idea to like an S&P minus the top 7. So there you still have to own them because the thing is, while you're building out the data center, all the industrials and all the services and a bunch of other stuff, they still benefit from it. So you don't want to be out of that market. For the next few years, you want to be buying whatever these hyperscalers are buying, which is a lot of physical things. So you want to be in it, and the hedges are cheap. So the other, like the 493 stocks, you go long and you hedge it. I would stay away from government bonds and IG bonds. IG bonds are like super tight. Government bonds, if we have stagflation, which is kind of the bad case scenario, they're not going to do well. If we have growth with inflations, they're going to underperform. The only way government bonds will do well is if we have a massive slowdown in growth with less inflation or like a big crash in inflation. Very hard to foresee that because that $1 trillion in spend, that for the next 1, 2, 3 years, that's extremely inflationary. So no government bonds there. High yield, I'm kind of neutral on, so most people don't own it anyway. Bitcoin, I would own outright without expectation of like immediate return, but the risk reward is quite positive. And like I said, Bitcoin doesn't work in the short term. There's no catalyst, but the MicroStrategy headwind has largely resolved itself. They don't need to raise money for the next, I think, 18 months or maybe even 2 years. So that was like a big headwind. The DATS blowing up was a big headwind. The ETF inflows turning to outflows, the headwind. The ETF inflows into Bitcoin, I think in July were positive, like almost every day, something like that. So that has reversed. So certainly the absence of negative catalyst is so that one. And then you don't own a hedge because the put skew is like very high. So I think Bitcoin just buy outright. And similarly for gold, I would also own gold without hedges. That would be my like mini portfolio. And then I would stay away from smart. Unfortunately, hurts my heart to say that, but all smart contract coins. even like Ethereum, Solana, and certainly all like the smaller ones, because there's like issues with business model. I think what's working in crypto specifically right now, you got to have applications that actually make sense for people that make money, which is why I think tokenization is working, RWAs are working, stable coins, payments. The space that we work in is the RWA tokenization. So that's going to work because that has real utility for people. But if you look at the valuation of a lot of the altcoins by any traditional metric, it is just completely sort of decoupled from their FDVs and market caps. So I'm not predicting anything. Again, it's not financial advice. But for like a family member that's thinking medium to long term, there's no margin of safety there.
Yes, thank you very much. RWAs and these different types of crypto assets niche, that would be a perfect topic for our next panel discussion. But we went very broad, we went very macro level and touched on many different topics. Thank you very much. To conclude, I just reiterate that my guests were Iggy Ioppe from Theo and Gordon Grant from Bitwise. Thank you very much for this panel discussion.
Thank you, Jakob. It was super fun.